with the name of Allah. In this lecture I will explain static and flexible budgets. In the last lecture we had studied how to set standards. Now I ask you, are standards the same as budgets? In fact, no. A standard is preparing for 1 unit, but budget is preparing for volume or many units. You can prepare a budget in 2 types, either a static budget or a flexible budget. Static budget is a budget that based on one level of output. Flexible budget is a budget that based on many levels of output and could be adjusted in accordance with the changes in actual output. Example 1. Consider the following budgeted amounts of a company for April of the next year. Units sold 12,000 units, selling price 180 per unit, variable cost 99 per unit, fixed cost 710,000, required prepare static budget for April. A static budget is based on one level of output. Here units sold equal 12,000. So revenue at 12,000 equal 12,000 times 180 equal 2,160,000 minus variable cost. Variable cost equal 12,000 times 99 equal 1,188,000 equal contribution margin 972,000 minus fixed cost 710,000 equal operating income 262,000. Example 2. Consider the following budgeted amounts of a company for April of the next year. Selling price 180 per unit, variable cost 99 per unit, fixed costs during April 710,000. Required prepare a flexible budget for April at levels of 10,000, 12,000 and 15,000 units. Flexible budget is based on many levels of output. Here we will prepare flexible budget at 10,000, 12,000 and 15,000. Revenue at 10,000 equal 1,800,000 minus variable cost 990,000 equal contribution margin 810,000 minus fixed cost 710,000 equal operating income 100,000. The same as at 12,000 the operating income 262,000 and at 15,000 the operating income 505,000. After preparing the budget, we use them in variance analysis. A static budget variance is level 1 of analysis. It gives the least detailed comparison of the actual and budgeted operating income. A static budget variance equal actual result or actual net income minus static budget amount or budgeted net income. For example, if actual net income equal 1,200,000 and budgeted net income equal 1 million, that means there is a static budget variance 200,000. 200,000 favorable or unfavorable? Favorable means the performance is good, but unfavorable means the performance is bad. Here the performance is good. Why? Because the actual result is greater than the budgeted result. Example 3. The actual result and the static budget amounts of April are as follows. Actual result for 10,000, revenue 1,850,000, variable cost 1,120,000, fixed cost 705,000, operating income 25,000. A static budget amount at 12,000, 2,160,000, variable cost 1,188,000, fixed cost 710,000, and operating income 262,000. Required: determine static budget variance. To calculate static budget variance, actual result or actual net income minus static budget amount. From the example, actual result is 25,000, static budget amount 262,000. The difference between them is static budget variance 237,000. Favorable or unfavorable? Unfavorable. Why? Because the actual result is less than the static budget amount. Another level of variance analysis is flexible budget variance and sales volume variance. Flexible budget variance and sales volume variance are level 2 of analysis. The static budget variance of operating income is split into two categories: flexible budget variance and sales volume variance. Actual result minus static budget amount equal static budget variance. If I put in the middle flexible budget amount for the actual level, I will take from the first box actual, so actual level, and I will take from the last box budget, flexible budget. So flexible budget amount for the actual level will split static budget variance into two categories: flexible budget variance and sales volume variance. Flexible budget variance equal actual result minus flexible budget amount for the actual level, and flexible budget amount for the actual level minus static budget amount equal sales volume variance. Example 4. A company has the following data during April. Units sold at actual result 10,000, at flexible budget amounts 10,000, 12,000, and 15,000. Revenue, variable cost, fixed cost, and operating income. Operating income for the actual result 25,000, for flexible budget at 10,000, 100,000, at 12,000, 262,000, and at 15,000, 500, and 5,000. Required: determine flexible budget variance. To determine flexible budget variance, you need two numbers: operating income at actual result 25,000 and operating income for flexible budget amount at actual level. Here actual level is 10,000, so the operating income is 100,000. So flexible budget variance equal actual result 25,000 minus flexible budget amount for the actual level 100,000. So the flexible budget variance equal 75,000 unfavorable because the actual result is less than the flexible budget amount for the actual level. Example 5. A company has the following data during April. Actual units sold 10,000 units. Actual operating income 25,000. Operating income according to static budget at level of 12,000 units 262,000. Operating income according to flexible budget at level of 10,000 units 100,000. Operating income according to flexible budget at level of 12,000 units 262,000. Operating income according to flexible budget at level of 15,000 units 500 and 5,000. Required: make a performance report that illustrates the possible variance analysis of static budget. To calculate variance analysis of static budget, you need three numbers. First, actual result. Actual result here is 25,000 and static budget amount static budget amount here is 262,000, and flexible budget amount at actual level here is 100,000. Actual result minus flexible budget amount for the actual level equal flexible budget variance. 25,000 minus 100,000 equal 75,000 unfavorable because actual result is less than flexible budget amount for the actual level. Flexible budget amount for the actual level minus static budget amount equal sales volume variance. Flexible budget amount for the actual level 100,000 minus 262,000 static budget amount equals sales volume variance 162,000, unfavorable because the actual is less than the budget amount. Actual result minus static budget amount equals static budget variance. 25,000 minus 262,000 equal 237,000 unfavorable. This number you can calculate it by two methods. The first one is actual result minus static budget amount. The second one is flexible budget variance plus sales volume variance equal static budget variance. By the end of this lecture, you have skills to determine static budget variance, flexible budget variance, and sales volume variance. Thank you.